Welcome to the Broken Pie Chart Podcast, episode 360. I'm your host, Eric Moore. With me once again is Shane Skinner and Mike Snyder. All right. So, Mike, I know you won't be recommending people watch the college bowl games or playoffs because they will have already happened by the time. Actually, Monday, game's on Monday, isn't it? The college football championship, right?
It is. So for our listeners that listen right when the pod drops, maybe it could get in.
Okay. Yeah. So maybe you could recommend that. That's a pre-recommendation. We'll wait for the full recommendations at the end. But all right. Exxon Energy. Like if you were a contrarian last year, I think we even said this on one of the shows, like what would you buy? It's probably energy. So Mike, I'll start with you. Did you borrow money on your house to buy Exxon?
Unfortunately, no. And I remember us talking about that, and I was a little iffy on it, on whether I would allocate more to energy. But you're right, that is the contrarian pick, and you know it's played out well so far for the entire sector.
I mean, I think there's a geopolitical thing here. There are oil fields, not necessarily in Venezuela. I think it's Guyana next to Venezuela. Exxon has a big interest in that. At least I watched that in a documentary, I felt like. And, you know, this stuff with Venezuela seems like less likely that they're going to go take that. Seems interesting. But, you know, I mean, nobody wanted energy. If you look at the year-over-year growth in sales, growth in earnings for the energy sector last year, nothing. And I mean, on a technical basis, Shane, you look at, looks like, you know, Exxon, it's broken out above its, I mean, I would call that an upward sloping channel, although I would say it's more sideways than upward, but it's broken out, Shane.
Yeah, they pay what, 90 something cent dividend. Now they're up to $1, I should say. But over the past 3 years, they've averaged between like 91 cents and $1.03 on their most recent. So it's a dividend paying stock. It's, like you said, sort of slightly up over the past 3 years trend wise, but it's been mainly sideways in a channel. It's starting to break it, as we see historically. When this channel breaks, it looks great, and then quickly, the past one or two times it's done this, it's retraced back. So I think the question, you know, we love to harp on earnings and growth, right? I think the question is, does what just transpired actually translate to earnings growth for them, and how soon? We all know that sometimes stocks just catch a bid sometimes because big geopolitical or news events happen and everybody sort of rushes in. So it'll be really interesting to observe this over the next 3 to 6 months and see how it sort of plays out. Is this a newer long-term trend forming here and we're going to see more upside, or is it going to do what it's done in the past and then the next couple of months revert back?
Yeah. By the way, don't like trade on anything that we talk about. That's we buy markets, we hedge them, we buffer them. Mike, people who bought June of 2014, the last high price, and this isn't total return price, so they've also been paying dividends, but 50.05, it's 47.69 ish as of when I looked at it. I mean, are the people who bought in 2014, Mike, going to be like, oh, thank you, I'm finally back to break even, I can get out? Like, technicians would say stocks have a memory.
Yeah, I don't know that you're happy that you're back to break even in a pretty historic bull market. So, you know, is it time to dump and get into something that's viewed as higher growth, or is this a story that's going to continue?
I mean, it's really commodity. I mean, look, oil is part of the commodity complex. Definitely, if you're looking at a broad commodity, you know, something like what is it, DBC or CERY from that's State Street's. I think I'm getting the tickers right. They are very energy centric, and so if oil is making a comeback on price, if these companies, if flows come to the energy sector, like think about it this way. Exxon at one point was the number one market cap company in the world, I believe. It's definitely on the S&P 500. They're not anymore. I think their market cap is what, like 550 billion? Not too shabby, but it's not 4 trillion. Like
peanuts compared to the rest of the market.
I mean, yeah, compared to that. What I think, Shane, this represents though is continued broadening out beyond the Mag 7.
Absolutely.
And we're going to be doing a webcast soon for a lot of our institutional clients in a couple of weeks. I'll put a link in the show notes if you want to. Actually, you know what? I think it might only be institutional only. I'd have to check on that. So I'll see if I can actually post it. But regardless, like I'll give you a hint. One of the things I'm going to show you is if you look at the equal weight, that has outperformed since, I think, July over the Mag 7. I believe it's July. And we see that it's really not the Mag 7 anymore. I mean, energy was left for dead. So if money's going to energy, that's definitely broadening, Shane.
Absolutely. And I think that one thing that we should clarify here for listeners is that while there is a strong correlation with the price of oil and companies like ExxonMobil, ConocoPhillips, et cetera, oil's performance does not necessarily translate to good or bad. Meaning, if oil's down, you would think that a company that sells oil or produces oil might not be making as much money, but there's a lot of other areas to this business than just simply selling oil, right? Upstream, you've got exploration and production, which is a huge driver. Downstream, you've got the refining and marketing aspect. And then there's, of course, like the chemicals section of this business. But I think, again, that's where is the growth coming from? I don't think it's going to come from oil prices skyrocketing. OPEC's been cutting. Oil prices seem pretty stable. This administration seems very pro trying to keep the price of oil down, keep gas at the pump cheap. And so the question becomes, okay, if that's not what's going to drive a ton of the growth of revenue for Exxon, what is? And I think the answer is the market thinks that, hey, with this Venezuela thing, there's going to be a lot more opportunities for exploration, production, refining, and things of that nature. So we'll see if that plays out.
I mean, they have other sources of input too. The refiners. I think Texas does a lot of the. What is Venezuela? It's not hard crude. Like there's light sweet and there's hard crude.
Yeah, there's variations.
But I think now if Venezuela provides another source, look, I'm not an energy analyst. Certainly I don't analyze individual energy companies, but oil, by the way, just looking at the generic first contract on WTI, yeah, it's back down below 60. So
I mean, I think we see 40 before we see 80 in oil. That's what was your prediction on the prediction show? I'd have to pull that up and see. I think I said 45. I think I said it closes right around where it's at. But if we were to have to pick, hey, is this going to go up or down 20 from here? I think it's going to go down before it goes up.
Like commodities are also interesting. Mike, I think last week, did we talk about copper? We touched on it. So, Mike, I'm watching the local news. I really wasn't watching the local news. It was on. So like somebody left it on or left the channel on. And I see at the corner of my eye, I don't know anything more about it besides walking by it, that Amazon is doing some deal with an Arizona copper company to get copper to use in their data centers. Like,
there you go.
I feel like, I don't pretend to know where copper's going. I mean, if demand is more than supply, you think, but like Mike, that's these other sources of demand. I mean, this AI thing, just when you think, okay, well, AI, you need this, you need energy. I guess you need copper too.
Yeah. To build out, infrastructure, and it's, having Amazon, buying copper certainly could be a strong driver of that. I did want to touch on the market broadening out.
Yeah.
And I think we're not only seeing it sector wise, like we've seen energy start to perform well, but we're also seeing it within sectors themselves, and the larger stocks actually underperforming their own sector ETF. Like if you look at SOX, for example, SOXX, which is a semiconductor ETF, it's up 13% this year. If I told you SOX was up 13%, what would you think NVIDIA was up this year?
Up 15?
Yeah, right. It's flat.
Yeah.
So you have some of the smaller companies, even within these high-flying indexes, that are starting to outperform the larger companies, like Micron and Intel have both performed very well year to date. By
the way, Mike, I knew it was flat. I did that for the listeners, for the effect.
Thank you. I knew that you knew too.
But no, it's a good point. Like, and the funny thing, SMH is definitely more market cap weighted when it comes. So SMH is it's the VanEck, the semiconductors ETF, where SOX has less weights to each company. And SOX, I believe, underperformed SMH for, going back to what, Q3, Q4 of 22. So no, I actually could look at that and see where SMH is based on the, the weightings there. But I mean, here's the other thing too, like to follow on your point, Mike, like semiconductors didn't go anywhere for a while. Like they made their run early. Like they were early. They saw the AI thing coming, the picks and shovels of AI. And then really they had this period where they went nowhere. And it feels like they're starting to make another run. And look, I'll let you know in 6 months whether they do or they don't. But I'm glad you brought that up. I mean, you look at some of these companies too, like Shane, we've talked about this. Last year, Google, and who was the other Mag 7 that outperformed? It's Google and somebody else. NVIDIA. Yep. NVIDIA. Apple was up, 8%? Something like that?
Yeah, about. Nothing crazy.
Yeah,
very modest.
Yeah,
Meta. Didn't we talk this week about how crazy it is to see this market near all-time highs, and you've got Microsoft off of its all-time high of 555. It's trading at 459 right now. You're 17% off all-time high in a name like Microsoft. What about Meta? Where are we at on that one? Another one, topped at 796. It's now trading close today at 620 and a quarter. So, you're talking about 22%. So you've already, and we could do this with the whole mag and not everyone's down, but it just further goes into your and Mike's, argument on this broadening we're seeing. I can't remember the last time I've seen Microsoft and or a name like Meta down this much and the index be near its all-time high.
I don't know. I mean, things happen in cycles sometimes, and there's these different regimes, different periods. And for a while, it was a lot of the big stocks were going up. I will tell you that January 1st through April, the Mag 7 underperformed. They underperformed everything. Of course, as the market's coming down, the stuff that was the highest beta names, the highest vol names, they all came down. But no, I mean, this reminds me, I keep going back to the 90s. I feel like in many ways, it's a replay of the 90s. And we definitely had the internet stocks that came in towards the end of the 90s into the March of 2000 was the high there. But to me, this is healthy if you're looking at the market. I want to bring up something else. And we always say earnings are the number one thing above all else, because over the long term, markets tend to follow earnings. If you have earnings growth, you have markets that grow. The multiple goes up, goes down over time. So this is from Peter Maluk on Twitter, posted a chart, S&P index price versus S&P 500 earnings via Robert Shiller's data, 1900 to 2025. There is a 90% correlation between the price of S&P 500 index and the earnings. So as earnings are growing, the S&P 500. There's an interesting one though in like 2008, 2009, they sort of decoupled, and that was interesting. But yeah, and that's the only reason why these two lines aren't one on top of each other. But Mike, when you look at something like this, first, it's no surprise. We know this. But if you're the bear, you're saying that the analysts are getting the earnings expectations wrong. Like they have overshot earnings. They're overestimating what companies are going to earn, what sales are going to be, and what margins are going to be. But look, if the earnings come in where they say they're coming in, it's pretty good.
Well, there is a gap, right, where we are right now between the S&P and the S&P earnings. So couldn't a bear also just say that the market's overvalued? Okay,
no, that's fair, and it doesn't have to stay at a 23 forward multiple,
right?
Mike, would it surprise you if earnings could grow and the multiple could contract and price would go down?
Yes, exactly. No, that wouldn't surprise me. I think what a chart like this does is it puts into perspective the longer term plan for investing. And that is, if earnings continue to grow, the market's going to continue to move up. And there's going to be blips here or there, but eventually they trade back together. Like you said, in 2008, there was this decoupling, but eventually they come back in line. And so as long as you believe earnings are going to continue to grow, regardless of what you might think is going to happen in the short term, long term, the market's going to continue to follow that.
I think the trailing PE in 2008 or 2009, I forget when it was, I feel like the trailing PE was like 70 because the earnings were so bad on a trailing basis. And one of the things that, from my memory, the companies were doing this is things were so bad. If you're running one of these companies, you're like, let's write off everything we can. Let's write down everything we need to write off, get everything off the books. It doesn't matter. Like, no one's going to kill us over having bad earnings during the great financial crisis. And right. I think you almost had, I'm trying to remember if earnings were negative one of the quarters, like the gross, $300. I'm looking on Bloomberg. Earnings per share forward 12-month estimate is $300 per share. $3 per share. We're at a 23.18 forward PE. So let's think about this for a second. 23. I might be high on my. Hang on. Let me redo the PE. 69.4. So we closed what? 69.40. Divided by 300. Okay, no, 23.13 is our forward PE. So let's think about that. If the PE ratio, the forward PE goes from 23 and change to 22. So let's say it goes to 22 times. Well, what does that mean? It's 22 times 300. The market is at 6,600, closed today at 69.40. Like, Shane, that's how sensitive it could be if there's a re-rating or a valuation change, a multiple contraction in the market. Going from 23 to 22, it's only a 4.34% reduction in the forward valuation, Shane. Like, it's pretty sensitive, the multiple to price here.
Yeah, absolutely. And I think the main takeaway from looking at this chart more than anything is that when earnings expectations pull back, or earnings, I should say, right, the market follows with it. Very, very few times on this chart do you see a significant pullback in earnings and the market not follow or already have been almost like pricing that in. And so I think it just goes to reiterate or reinforce that argument that, at the end of the day, future expectations are what are driving what's happening right now. And the moment you start to see some volatility in those future expectations, you can see some major follow through to the downside on the markets end.
So do you want to share how we kind of think about, at least how I think about, here, I'll share this, how I think about when I do my predictions. I'm like, where do I think the earnings are going to be on December 31st of next year? the forward 12 months. So in other words, like at the end of December 31st on 2025, we had a forward 12-month analyst estimate. And then I'm thinking, well, do I like the analyst estimate? Do I think it should be higher? Do I think it should be lower? And then, and then you take them multiple times. In other words, right now, the year plus one forward earnings per share estimate on the S&P 500 is $344.54 a share. What that means is if we get to December 31st of 2026 of this year, basically in, now just under 12 months, what you're saying is if the forward 2027 earnings are 344.54 at that point, you're like, okay, if we're at a 23 multiple, then 23 times 344.54 is what? See, this is the problem with doing this live. I hit the wrong button. I divided. Hang on. 344 times, times 23. So that brings the market to 79.24.42. Like that's how, and that's why, all these predictions are so dumb, because you could be completely correct on the earnings but get the multiple wrong. You can be completely wrong on the earnings and get the multiple right, and you still go to the same spot. All right, our audience is probably getting bored of all my number crunching, but it's just like this stuff matters. I will tell you too, like sales expectations, our growth is 6.89%, rounded 6.9%. Like that's high. That's high based upon, historical averages of sales growth. I feel like sales growth is more like 3 to 4%. So, all right. Where do I want to go? Mike, let's talk about tariffs and the Supreme Court. It was interesting because we saw the markets kind of ease off a little bit, and we saw vol jump because they thought the decision was going to come out on Wednesday. Mike, that didn't happen. I feel like the market was like, okay, we're not getting it. I got to be honest, though. If the market thought that ruling was going to be a problem, wouldn't the market have sold off more and vol be much higher? Like, I feel like the market's discounting what's going to come out already. Yeah,
it seems like it's digested it already. Or otherwise, like you said, I would have expected a much bigger move for not getting the news. There's still uncertainty around it, but the market doesn't seem concerned with the most likely outcome, which I think is that one way or another, this finds a way to get passed.
In other words, they're going to find a justification. Like you might have a ruling that says, okay, you can't do it under this narrow statute, but you can do it. But it might be interesting if it was resubmitted using this. And we think they're likely to succeed on choosing another method. And therefore, there's no rebates of the Treasury revenue. Like, I don't know. Shane, what do you think?
I mean, with prediction markets now, it seems like everywhere's pricing. I think it's something like 80% right now is the expectation that they rule against the administration and the tariffs. I said it earlier in this week. I wonder if this market's gotten so efficient that a lot of this stuff is just viewed as noise. It gets priced out. Market probably just wants something calm, whether it's a yes or a no, just a clear yes or no. And it needs clarity after the fact. So if they rule against, I think the market just needs to know that money either, what was collected now is just going to stay as is, but going forward, they can't do it anymore. I don't know how they pay this back. I've seen multiple executives and people go on CNBC that have said that, look, if the Supreme Court rules in favor against the tariffs, a lot of these companies and corporations want the money back from the government. So as weird as that sounds, I mean, if that money just goes away from the government and goes into these corporations' hands, then that might be weak dollar strong for stocks, right? So I think that's so multi-layered and there's so much going on that you can't necessarily chalk it up to, well, if they rule against, this will happen. If they rule for, this will happen. And this is why you hedge through situations like this, because no one really knows how the market's going to react. But I'm with Mike. I think most of it's been priced in or digested already.
Yeah, I mean, I go back to the tariff tantrum in April, and I would say the market priced in something that was different than was released that day. And sure, the market could get this wrong too. They may be discounting all believed information, and we'll see. The other part too is with, I'll just touch on this briefly, and then I want to get to some sentiment stuff. So the Powell versus Trump. I mean, Powell his term as chair is up, in May. So you've got, is it 3 meetings or 2 meetings? I think they're taking at least one of the months off. So, I mean, that's ending. He could stay on as a governor, but not the chair. And that gets a little wonky because then you don't have his open slot. Although I think Bostic has announced he's retiring or leaving, so there will be somebody to nominate. Of course, he could nominate somebody who's currently on the Fed. I had a couple of people ask me, does the Fed take taxpayer dollars towards renovating? Because the contention is it was going to cost, I'm making this up, $2 billion, and it wind up being $2.5 billion. And I guess he made some testimony to Congress. And my quick answer is yes and no. So I don't believe the Fed goes to Congress and gets a budget. But what happens is they remit excess revenue back to the Treasury. So if let's say their excess revenue would have been $500 million more had the project been $2 billion instead of $2.5 million, I guess in theory, the Treasury would have, in the U.S. quote unquote taxpayer, I guess, the Treasury, whether you want to say they're one and the same, would have gotten more money. But I don't know. All right, let me go to sentiment. And I did a little bit of analysis here. And one of the things, I guess I haven't shown you guys this yet. Did I show you the sentiment stuff, Mike and Shane?
Yes.
Okay, so you know. Yeah, and so what I looked at, it didn't make sense to me that sentiment was this low while we're at all-time highs. And I've heard a number of people repeat that. So what I did was I used Bloomberg and I went in and I said, does the prior 12-year return on the market, does that have an impact on whether people are happier or not happier when they get asked on this sentiment survey? Whoever gets asked, I don't know. And the answer is, it is mild at best, meaning if the market was down over the prior 12 months, the prior 12-month return was down, it's slightly sloping down and to the left on a scatter plot. The statisticians will know what I'm saying. But the R-square, the relationship is very low here. So it doesn't seem like where the market's been over the last 12 months really matters that much. And then I said, well, is sentiment right? Meaning, if people are really bearish on I don't know, whatever their sentiment, they're on the economy, on their situation, whatever the heck they're trying to measure, is there anything really that matters here? I mean, does sentiment matter? And the answer is probably not. I looked at the sentiment level on a scatter plot, did a low regression against the forward S&P price return since 1979, both those from 1979. And the answer is the relationship's a little bit more, but not really. So I don't think sentiment really matters. And, I'll do a little more work on this. It is interesting, though, that sentiment was this low, 1980s. And it was this low of the 2008s, 2011, 2022, and then 23, 25, 26. So
would you argue that it's less about sentiment and it's more about, is sentiment actually driving action that can cause change? anybody can
I don't
say,
even know. I think you just throw this out. I think it's meaningless, to be honest with you.
Yeah.
I think it's just meaningless. And, but I was interested because I had a hypothesis that it didn't make sense.
And it doesn't.
And I went and I looked at the data and I said, no, there's not really a relationship. Like, I can't say, why are people this unhappy on a sentiment indicator when the market's near all-time highs? That was my conjecture. And no, it turned out to be null. Like, it doesn't matter. So, all right, let's get to, I know we got a quick timeline today. Let me get to recommendations. Shane, I'm going to go to you first.
Oh, put me on the spot here.
If you don't have anything, just pass. That's okay.
No. I'll go with, oh wait, I already did Arrested Development. We're still watching through that right now, but, no, I got nothing this week. It's been busy. It's OPEX week. I didn't watch a lot of shows or movies.
All right. I watched the movie so the audience doesn't have to. I don't know why I watched this. It was on HBO, Elevation. And I'll read the thing here. It's a post-apocalyptic action thriller film where basically there are these mysterious apex predators that kill everyone unless you're above 8,000 feet. And naturally, they find a reason why some people have to go below 8,000 feet. I was entertained. I don't think I need to watch it again, but I think it was pretty good. I was actually entertaining, but it's not a strong buy. It's a hold. Mike, what about you?
Mayor of Kingstown with Jeremy Renner.
Oh, okay. It's been on my list for a while. Strong buy?
It's a buy. It's a buy. It's 4 seasons in, and I've just finished the 4th season, so I've watched it all. But it's good. It's dark, but yeah, it's good.
Eddie Falco, I love it. I didn't know she was in this.
There you go.
Nice.
I don't know why. When you said Mayor of Kingstown, I was thinking of Mayor of Easttown.
Yeah, sometimes I call it that.
Yeah, which is a fantastic show. That is a strong buy recommend. That's on my conviction list for sure. So, all right. Well, let's leave it there. We'll be back next week. Hopefully people enjoy or have enjoyed the holiday weekend, depending upon when you're listening to this. Mike, enjoy your the college football championship, your Indiana Hoosiers trying to win, which most assuredly is their first.
Of course. Yes.
So that will be interesting. Enjoy watching that. All right, Shane. All right, Mike. Thanks again. And for everyone else, talk to you soon. Take care, everyone.